Greetings, market rebels. Welcome to this week's macro measure. It's Sunday, May 7th, 2023, a little bit of in front of 3 p.m. on the East Coast. I'm Wayne, my partners. Ryan's already gotten the market outlook, market overview out for the week. So let's get a few things taken care of, and then we will get into our program. Here's our trusty disclaimer. And oops, overdid it. There's the trustee intellectual property rights notice. And then finally there we have this week's program. I'm just going to leave that up there just a little bit. Didn't feel well this morning, so hope to record these earlier, but it may have been actually more beneficial that it worked out that way. So this is what we're covering. There's plenty after this, but I'm not going to go through so many of the more recent ones so we can get into things. I just need to reposition things, so just bear with me. And then we will reposition our slides so I can make sure we cover everything properly and get the right share going. So some of the things I'm going to tick off are, let's see, we'll get started with our browser tabs, and maybe we'll come back to these as well. But the main things for this week are that I think once again, we saw how important the calendar is. And that was a really emphatic reminder last week. And the mega caps are as well. And you saw what happened really in the lead up to FOMC minutes. Some of the economic reports have come out, kind of soured things. FOMC didn't seem to really help. And then, Apple, while creates this amazing recovery by weeks, and we've seen it many times. So once again, I think things were probably not working out ideally for the bullish scenario, and somehow again something really arose that allowed them to justify this big move up again. And you just always have to keep your eyes on that calendar and the earnings calendar, economic calendar, Fed speakers as well, things like that, because you could see that the gang can really utilize these things to put some kind of a spin on whatever they want to do, really, in prices is how I look at it. So we went again from risk off early to risk back on again, which was, again, I'm calling def maneuvering part two. We saw that the prior week, but we're really going to cover now what I'm calling opposing factors this week. So to go deeper into this, because unfortunately, I don't think there's a lot of great stuff for us to seize upon in the charts again after the way last week unfolded. I looked at so many things. We'll review those, including DXY, TNX, VIX, SMH, quick sector view, the four major index ETFs we typically look at, and then we'll take a look at some of the mega caps. And it's just not that easy right now. It's become more difficult. So based upon the calendar, we're primed to go. If we do go, I do think we could have another short squeeze phase that really is surprising to, I think, many, because I think it could be people wondering, well, how's this even happening? Again, how's this getting even more kind of absurd? But I've seen it many times, and it's certainly possible. We always have to be on the lookout for false breakouts or breakdowns. So not really worried about that. Because that's something we kind of reiterate all the time. So I think everyone that follows these videos and in the services really realizes that's always a possibility if they've been in the services for any length of time. So I do think there could be sustained squeezing on a breakout. I am not forecasting that at this point. I think you'll see that in the charts. So we have the charts, we have the way the market's been behaving, and then we have that at odds with many macro factors is, I guess, one way to describe it. That's what I chose. So what I wanted to start out with, and I think we'll come back to this, is they've been using these names, right? The Apples, the Microsofts, the Metas, mainly to keep, well, Berkshire too, keep things, Visa to a degree, going strong. And that's been the MO for as long as I can remember at this point. That they just really will overdo it in terms of how much they jam up those names because they're such heavyweights. And so we're going to have some of these tabs are going to cover some of that. I just wanted to start out with a reminder that because we did bottom in October, this is one that we've been checking on every week just to kind of remind everyone. So according to history, right, market history, this would be fairly common. So I don't want to discount that as much as I find it difficult to believe that it's legitimate. This is also, again, the reminder, the third year of the presidential cycle, which is the best year by far and nearly double the second best year, which is the year to follow, okay, typically. This is where we are with the so-called sweet spot in that pre-election year. And you can see that that first half of the year is pretty good. And of course, we have May and June and probably into July a little bit potentially to really continue to go according to this particular cycle. Okay. Now, another one is here, right? I found this one, and this would be the month of the year, the trading day of the year. And here we have approached, right? We've come into May, and you can see what happens here in terms of it's really very much in line with exactly what we just showed here, right? It's very much in line with the so-called sweet spot. So this is Jay Capel, I guess his name is, or Capel, that's his take. These are some of the things I alluded to last week, where you get, now this one I think is from earlier in the year, but I just wanted to share it because we've had a lot of different developments in the market and other factors that have developed in similar ways that suggest we should have a very strong year, which is in line with what we've seen already. Okay, so you can pause any of these, of course, and go check them out for yourself. But I don't want to get into the finer points of all this stuff. But I just want to keep noting, because I did kind of gloss over it last week, that a lot of these things have shown up at some point this year. This one, I think, is from the end of March. And you have a situation where the full year's never been lower after this kind of first quarter return. Never. Okay, so 16 out of 16. And it's, again, this is from Ryan Dietrich, and a lot of people accuse him of always putting out rainbow and unicorn views. I think he and a couple other folks that do that typically are at it again this weekend with pointing to the fact that they say that market breadth is not that bad. You could cherry pick whatever, and I guess that's the problem people have with him and some bears that do the same thing, that they cherry pick certain things. But I don't see how you can really argue that market breadth is wonderful, which is one thing I think he's suggesting. It's not nearly as bad as people are making it out. I think it has been really bad. We showed that. I'm even going to show it again this week. But this was another kind of market development, right, where we just had this big reversal from these cycles, right? This composite trend model. And I can't even go into that. It's not my model, but this is something where you have a 91% success rate over the next 6 months when this happens, and it apparently just showed up again. So just again, these are all the things that are out there. Now, we can also note that currently things are a little bit into the greed range, but not all that much, right? They're not too high. And once again, this is part of the fuel, I think, for this 11th week in a row, right, where this sentiment remains above average for the 11th consecutive week. I don't know what the record is, but that's still just continuing to print that way. And it's keeping, I think people are naturally skeptical, and they have got good reasons for that, but it generally helps the market act. It's a contrarian indicator, so generally helps the market go up. Now, this is what I found interesting, that there's a little bit, we're currently at 500-525 in terms of the target rate with the Fed. Now, there's a 91% chance that in about 5 weeks we stay there. There's a slight chance, as you can see, that we go higher according to the market. But this is interesting because look at this right now in July. By July, there's a much greater chance, according to the markets, that we already start to see a cut by July from where we are now. So that would be the very next meeting. And you could see that, yes, there's some people that still believe we would be a little bit higher, but overwhelmingly, right, it would be either we stay where we are or we go down by then. I'm not sure. That's not my area. I'm really not sure, but that does seem remarkable. So this is apparently the assumption is that, yes, rates just went up again. They're printed higher, but it's only going to be very short-lived, and we'll be back on the way down, not too long after. And even further, you can see how the expectations are by September. There's nothing, very little chance we're above where we are, and you have a much greater chance that you're slightly lower than where we are, and kind of an equal chance that we're either where we are now or we're even lower than that, than this particular this drop. So this is what the expectation is. It's very interesting. I guess they think that this is going to be handled incredibly deftly or to perfection. I'd be surprised at that. But again, it's not my area, so I really don't want to say too much about it. I just don't. I don't see that. I don't see that unless there's something really dramatic the Fed has to respond to. If that were the case, then the market would probably be under great pressure, I would think, well before the Fed does anything. So you should have a pretty nasty situation develop. But again, that's not what a lot of these market developments are suggesting. This I'm just putting here so I don't forget. I just want to remind everyone, because I know a lot of you are also interested in the metals. This is interesting that I can't verify this, but that JP Morgan holds such a large gold derivative short that it could be larger than the bank's total assets top money managers warrant. Now, I've heard things like this before, so it's not like this is new. But interestingly enough, we've been covering silver. We've been talking about it. I've been hoping it would go back down and kind of ignore the major cup and handle that is in there in gold. That's a very long-term pattern over years that could fire. And if it does, if you're someone that believes in patterns and their projections, it could deliver some really strong movement. Well, both of them could have really strong movement, but it's just starting to really to break out potentially. So there's a world of, I guess, possibilities. There's a world of remarkable developments that could await us, right? Given how, if this stuff really does take off, which again, I wonder if they'll let it, if they'll be able to maintain it, suppress it, whatever. But that's what I wanted to note, just because that's not what we cover typically. But I just found it interesting that both of these things appeared. Now, of course, we've known about this. If you watch Sector Situation, we've been talking about that for a while. But it's interesting that it's appearing here now to kind of counter some of those bullish developments that we've seen, right? This is a bunch of yield spreads, kind of like different durations along the curve of this duration versus that duration. But of the ones that were tracked here for this study, there's 100% of the relationships between different durations, the different yields between them, and when they're inverted. So from how they typically behave, and you can see that you get above 50. A recession is imminent when 50% of the yield curve is tracked, enter inversion. And now you've got 100% of them. So these kind of things are on the other side. What's also on the other side is, I would say, shenanigans. So if you look at this outlier in terms of non-farm payrolls, in terms of beating expectations, right? I mean, this is the longest this is the longest run by far. And so what's going on here? You have to wonder what exactly is happening here, right? That this just sticks out so much. Statistically, I can't tell you how much of an outlier that is right now, but I'm just guessing it's pretty darn big outlier statistically. Cities economic surprises rolling over relatively recently, just below there. But here's what's been going on with a lot of these things, right? They've been claiming that all these wonderful jobs are being created, but there's explanations potentially for all this. So this is one just kind of observation by some folks, right? That people, they're calling it new jobs created, basically when companies that are already hurting for employees, which is still the case apparently in a lot of different places, are getting people to come back because those people are finding it difficult to make ends meet. Here's where all half of the job gains are coming from: an Excel spreadsheet, which assumes that 1.84 million new jobs were created from new business creation. Okay, again, this is why I think it's hard to believe a lot of these things, because a lot of them, as you can see, right, a lot of this stuff gets revised lower later on top of it. So it might even be greatly fictitious even still, but they revise whatever it is lower. Here's another one that I came across. And so this is partially or potentially responsible for a big part of what we're seeing, where everyone's celebrating and acting like the economy's doing better, it's resilient. Meanwhile, right, Q1 GDP cratered to a very low level. And now one reason could be the way that they're forcing folks that make $600 on doing gig work for the year to actually have to file you need to have a 1099 to file your taxes for that. So this is bringing a lot of people that were just doing gig work that were probably not part of the employment rolls, the tax rolls, into that count. So it's very, according to this particular gentleman, I forget this guy's name, but he's got some, I forget this exactly what his name is, but he's got some good points. I've seen that guy many times. He makes good points, typically, my opinion. Now, here's another part of this. Consumers are going hog wild, right? They are basically, with rates even going up, you could see how much consumer credit is being tapped again. So kind of concerning, right? Second fastest credit card debt pace on record, just as rates hit all-time high. So I don't see this as a positive, right? That people are basically getting crushed in terms of borrowing and they're tapping it anyway. But that's me. As you all know, probably just a reminder that deposits, right, have been cratering in commercial banks because of what's been going on, which is, I guess you'd have to say, understandable. And you could see too that liquidity is actually dropping here. You can see that right there. It's kind of tough, but there's that purple line, and you've got versus your S&P. So not a good sign. Usually when you get these kind of things, there's catch down factors, but for all we know, liquidity will start surging curiously, and we'll have to figure out what's causing that, and it'll take some time. But you can check this out in terms of liquidity. This Bank of America study is suggesting that 51% of the stock performance that we've seen for this long was not driven by what the typical suspects, but more since the global financial crisis. You've seen the fact that there's been massive balance sheet or liquidity expansion, which again just proves the whole QE thing. Here's another thing that's keeping things elevated: corporate buybacks. They're continuing to boom. So with a lot of these big companies having gotten their stock prices marked back up dramatically, now they're going to step in and buy even more shares of their stock, which just makes me wonder. I'm not so sure if you think that's the best use of your capital, but it's all about creating the beat, right? They can say, well, we're making this much money, but we have fewer shares outstanding, so we're actually doing super. And everyone tends to go along with that because people just buy in this world tend to buy stocks and ask questions later. As we've noted, you've got most of your companies reporting in the S&P. The beat rate is about what we typically throw out when we write up things or part of ideas, and just the whole thing where they usually get 75 to 80%. It's just almost engineered, almost quarter after quarter, where they just beat. And you just wonder, right, if these estimates were anywhere near fair once they're aggregated, or the mean estimate, the median estimate, whatever you want to say, right? You'd be somewhere around 50-50 if you were putting out real numbers, but because they don't, and they just sandbag their actual estimates, it makes it possible for really, right, 4 out of every 5 companies to create a beat scenario, and then everyone tends to be celebratory about that. This is interesting though. Q1 blended EPS growth is down 2.2%. And then you've got 44 to 35 or what they're noting of negative to positive guidance. So you even have a ratio where the guidance is not, but it hasn't mattered, right? It hasn't really mattered. There's no rewards overall in terms of beats right now for this earnings season, according to this guy, Mike Siccardi. And I've seen him put out a lot of good stuff as well. So you haven't really gotten anything special here, but because you've been able to get it in the big names, that's what's mattered. And that's what we continue to harp on, because we've seen it so many times, and they're just doing the same old all over again. Things that should, I think, concern folks are things like this. Here's U.S. office occupancy. I mean, look at this. Look at this change. Here we are, right? We're a few years removed from the COVID, whatever you want to call it, and you're only back to about halfway, right, of where you were in 2019. So I don't know how that bodes well, but again, I'm not an expert in that. Here's an interesting one if you want a little counterbalance to all this bullish stuff and how they're pulling things off. But you've got your S&P 500 and you've got your Russell 2000 in terms of earnings. And you can see the point that they're making here is that small cap tends to lead large cap earnings, and they've started to roll over significantly. So this, I think, would be a cause for concern right there, especially because you've got this kind of extent of outperformance in terms of the basically US tech relative to the S&P. So they've got tech, again, priced to perfection or near perfection. And this hasn't really, as many of us know, hasn't ended well in the past. We did note this last week, but just to kind of confirm that only 32% of components of the S&P were outperforming the broader index. So it's the lowest levels they've seen since, well, you can guess it goes back towards that era, though. So that's from last week, but I'm just reiterating it again, which, again, this is why the Ryan Dietrichs of the world, I think, open themselves up to criticism, even though I think he puts out some interesting things, and I'm not really someone that sits there and argues with him. But, right, you've got to look at it a lot of different ways. You can cherry pick things, and I think that's what a lot of people have problems with it. And bears do the same thing. So I don't know why people have a hard time trying to come up with a balanced view on things. And sometimes, you don't want to force that, but it does help to try to look at the other side. But realistically, this is the narrowest leadership ever in an up market, according to the views here at JP Morgan Equity Research. We talked about that last week as well. So very, very poor market breadth, not something that you want to see. Then we've got this here. This is the same thing, right, that we just took a look at. And I don't want to go into all this, but a lot's going to be made of this. And it might start to, this is 2 standard deviations above the historical mean. Okay, so that tells you how stretched you really are. So a lot could start to be made of that in terms of rotation. I just wanted to mention it again for that reason. That's why it's in there a second time under somebody else's tweet. But some people may say, you know what, now that I've seen these major moves on earnings in this somewhat concerning environment, macro-wise, domestically, maybe, and internationally, if you look at Germany's recent economic news, that wasn't very good at all this week, then maybe you see players say, you know what, I'm taking profits here and I'm rotating here. So maybe that will bring back sector situation material that's we can sink our teeth into more, because it's been really hard with it just going risk on, risk off, and being able to only focus on one or two things here or there. Just more confirmation that this guy, Jesse Felder, is calling this a rare divergence between the NDX AD line and the NDX itself, but not something people want to see. You typically want to see nice breadth measures following the price action, and it is a cause for concern. The only problem is that these things can take a while to resolve themselves. I've seen that many times, and but I just wanted to note that I think breadth really is an issue. If you want to talk about, this isn't only from a week ago, but here's your big seven in terms of tech. The rest of the S&P 500 is up 3%. But the big part, right, the big seven are up 31% year to date. And this is prior to the Apple move this week. So just to give you an idea. So that's where you are, how things are concentrated. Check out, right, despite the buybacks, check out how mega caps pose a much greater risk to overall markets than what is currently acknowledged. Check out the revenue growth in some of these big names. And this is, again, after many of them have completed many buybacks. Another way of looking at this is that 47% of the S&P, according to Liz Young, are above their 200-day, right? Compare that to what we saw a month ago, 60 and 73. And so breadth has deteriorated. So this is something that I think we have to keep our eyes on, but again, it doesn't mean anything in the short term, super short term. I just wanted to flash this from Market Rebellion. This is the percentage of stocks above the 200-day moving average. And you can see that right there. And that didn't really budge all that much. In fact, it got really, overall, I'd say it got worse last week. So I think the market was primed to go and it wasn't able to. You could see that it really wasn't this really sort of groundswell of great stuff happening that delivered the movement. It was all about the stuff we typically talk about, the big mega caps and what they were able to do with them. So now we can take a look at charts finally, but I think that kind of setting of the table to know what we're up against is actually probably more important than the charts at this juncture. We'll start out as we typically do with the SPY. And the reason I'm saying that is, right, you've got a lot of people, just to be very clear, you've got a lot of people that think we're on the verge of a new bull market. And again, we very well may be, and my concerns that I have for it may be overblown. So I don't want to act as if there's no possibility that my instincts would be wrong. But there's a lot of market behavior that's suggesting that we should be higher. And we may, and we covered that earlier with all the tabs early on, but we haven't really broken out yet. And my point of mentioning that is that I think a lot of people believe that, and they've dumped a ton of money in on the long side. And so what that can create are really two major things. The way I'm looking at it is, number one, it would be that a lot of people have to go into heavy catch-up mode. If it turns out that somehow some wonderful things develop and all the concerns that so many of us have and share are not all that important in the end, and the market just goes on this march higher, and then we start to see better and better, the Fed starts cutting, better and better things start happening. That could happen. Can't say that it won't. But there's a lot of people that I think are still very, very skeptical and have bet against this or not bet with it. So you have that scenario where there'd have to be this major catch-up development, and it could create kind of what you would think would be like an almost irrational, relentless bid that we've seen at other times. On the flip side, if all these folks that just are choosing to play history, irrespective of all the problems looming out there that I think are there, that Ryan thinks are there, that I know many of you think are there, those folks that have already plowed so much money in, and I do believe there's been a lot of money plowed into this market and into certain stocks, they're going to be wanting to get out, of course, and that could create a real ugly scenario. So I think for that reason, that's why I've said that I think we could see a really powerful move once we do something. But as you can see here, what are we really doing? Right? We thought that they were on the verge of a possible breakout scenario at the way last week ended, despite not such a wonderful candle right there in the SPY. But they got overdone. We kind of noted that might need a little bit of backup, and they backed up a lot. And the early in the week news and the FOMC didn't help much. But the way that this and everything else really responded was through Apple on Friday. So now you have to say, well, we're still trapped in this consolidation. We're still trapped in this rectangle. We have not been able to get out of it. They tried to fake below it a few times here and there and bounce it right above the 50 in each case. May have a double bottom, little mini double bottom in place now. Maybe they are able somehow to push it through. I don't know what the driver would be, right? The Fed is 5 weeks off. Most of your big earnings are out now. So I'm not sure exactly what the driver would be, but maybe something will develop. That's all I can really say. I'm not positive. I just keep thinking about it. And usually they use the calendar like we've been highlighting. Well, what would it be? What would be the thing that really allows them to start to somehow push things up and justify it? But I don't think so. I don't think you can rule it out. But the bad news I have is, right, the long-term trend is, I think, still down overall because certain highs like this one have yet to be taken out that we made on the way down. But you're also, right, consolidating now for, if you look at this wide range, let me try to drop a rectangle on here for all of us. So at this point, we'd have to pretty much say that despite the fact that the market's advanced at times, we've been stuck in an even larger sort of consolidation as well. And that's not very well drawn, but you get the idea. And so what happens? I think you're still stuck in that for now, and we have to wait for at least the smaller one that we're in now to be resolved, right? And they haven't been able to break this out and go, nor have they been able to break it down. A lot of the long-term moving averages are now slightly upsloping, so that's a positive in favor of the bulls. The double bottom potentially here, a little mini double bottomish situation that's forming, is in favor of the bulls. But a lot of their calendar of what they can do with things seems to be gone. I do think, of course, this saved, right? This kind of still preserved, instead of breaking down and the whole third-year presidential cycle, the whole sweet spot coming under pressure, the rest of it, this did sort of save the day again by closing where they did. They were able to have a little bit of a mild pullback net from the prior Friday's close, so it's not the end of the world. So I don't think this is an easy juncture. Again, I hate to show up probably for almost like the 5th week in a row with, hey, this is tough. But all I can say, and it's not a pat on the back for myself, but all I can say is, right, we're not that far removed from where we came into this. So our take of, I'm not so sure what's going to happen next, has actually been a frustratingly correct one. And that happens a lot. Whenever I can't make a decision and really have some kind of a lean, I get that result. And so that should help. If you find yourself getting a similar result, that should help you to say, well, until I get a real breakout or breakdown, I've got to keep going for the singles and doubles. That's the best thing I could share about that. I do think the bulls took a little bit more control, but I think it's, excuse me, but I think it's sort of tenuous, right? Because with one fell swoop, you could be right back down below the 15, the 10, the 20 that are all up here. You could be on your way to closing this little gap, and you could have your short-term moving averages rolling over. And I could just keep going on and on and on about different things I looked at. And your RSI is middle of the road. You're at, I think on the daily, you're just under 55. So it's not even really overbought. It's not close to oversold, obviously, but it's kind of in that middle neutralish band. So again, you're at a tough spot where you don't have a lot to key off of too. Again, I think whatever driver unfolds, it'll probably be something that maybe I'm not focusing on. On the flip side, what the gang was able to do in the Qs was a little bit more impressive, because I do think they made a new high since the October lows that we talked about. That is slightly higher, I think, 323.63, 323.76, and it looks like this is the highest close so far. So we have to give them a little bit of a nod there. This short-term moving average view looks a little more constructive than the SPYs. There is still a little mini gap of other gaps too, but there's a little mini gap here if this is going to reverse quickly. But you've got their 50 in gold, your purple 200, and the other longer term SMAs all still upsloping. So this has been a little more impressive. Probably you could say, well, I'm going to say there's going to be, if this breaks out, where do we go to? And I think there's little gaps back in here. There's this is August, and there, of course, there's that high. So I think that would be the next place would be to, it tries to attack, close this gap here, and tries to attack this high. That puts you up between 2 to 3%. So I don't think we can rule out 2 to 3%. I do think with that end of the week save that they pulled off, that kept a lot of the cyclical stuff, just like with SPY, kept all the stuff we've been talking about, third year, all that on track for now. So it's another kind of like bold in your face jam job on news, and we're just going to impose our will on the markets and use this as justification. What they could do is start taking money off the table in some of these big winners and then start moving other stocks up, as they've done many times over the last couple of years, and do it in a way that keeps the indices buoyed. We've seen them do that many times as well. So I think there's another 2 to 3% there potentially. Right, aside from news developments, I would say that the intermediate trend is up. Right, the breakout attempt, you would think they try to at least create a false breakout, right, and before they pull people in, because they're so close to doing it. So I would lean that way in terms of what my expectations are. And I would take a breakout trade. So I don't want to sound as if I'm only a bear here at all. I would take the trade. I would just be very careful. You've got to be careful when so many things are at odds, right? And a lot of this is being done with, let's say, a deft touch of riggers by riggers. You've got to be really extra careful then, because some kind of story could develop and shatter this illusion quickly. That's when you can be really susceptible to things, especially right with this banking situation looming. So trade, be smart, roll up quickly, do the old quick trim. What I call the quick trim is you sell a 1 or 2 lot on a base of 10 contracts that you hold. When you hit a first or second target level, it takes a little money off the table, and then you can, even if you get that return back to trigger level and you close it out because you're saying, hey, look, this thing doesn't look like it can hold its trigger level, you still win, right? You still have a small win for your efforts, and it keeps a positive psychology. So, but I mean, overall, I'd have to say that this looks bullish as it sits right now. I give them the benefit of the doubt there. The diamonds are the third, probably one that looks bullish, and it's not nearly as good as QQQ, but again, it can if it takes the 20 out, which is really Friday's high, effectively, it's 4 cents away. That is a light blue line. If they take out the 20, they could be back towards the highs. Then you have to just wait. Can this thing break out? And I think that in the diamonds ETF, I think this 34, call it 15-ish area could be the start of something. But it has a little work to do before it would get up there naturally. So we have to wait for that to do a little bit more, but it's got a couple of percent before it gets there. So we'll see. Again, I don't know what the driver would be. I think that late save preserved bulls for now, but all these things are really in a state of flux, and that makes sense, as we really can't come up with a really reliable lean from week to week, because you're looking pretty scary on a Thursday, and then you could by Monday be looking like you just broke above all SMAs that are challenging recent highs. So it's very much in flux. And again, this is above that resistance level we had in place, they were able to bring it back down below there and rescue it right away. We've seen these shenanigans many times. It's not like this is something that should catch you off guard, because you know that that's exactly what they're capable of, especially when you know that Apple's looming, biggest stock out there. It's got the biggest weights. So it is what it is. We just got to deal with it. And I think our folks are doing okay overall and hanging in there, making some decent little profits. And some of the banking trades have been really good in the regionals, but it's not an easy market yet. I mean, hopefully we'll get back to a stronger trending phase. But here's the IWM. And again, this remains kind of the odd one out. I mean, it's just this action here below this triangle that I drew in. This just doesn't look good, right? And you made a new lower low. But this has really been, we've used this a lot for trading, because this is really a good trader. There's a lot of really powerful moves too that develop just off the opening of trading. So you can get involved in this thing, and in some cases you can be done pretty early. I think with some of the moves this thing puts together. Of course, it pays to be on the right side of those moves, but you get the idea. There's a lot of opportunity in this thing at times, but it could be above the 20. Could work its way back to the 50 there in gold. There's a gap that it could start erasing right away if the weekend brings negative news and starts the week off on a negative tone. But I think this is the least impressive, and it kind of is in line with the profit tab that we saw in the browser earlier, and the cyclical side of things. Like cycles wise, this one doesn't look as good as well, and it's really not far from key lows, right? So this would be sort of one of the problem areas. And so this would be potentially an issue, right? If this starts cracking, it could potentially create bigger cracks elsewhere. So I think you can see that really the Qs look the best, and the IWM, I think, looks the worst. But I wouldn't start thinking up and away on IWM. And I've said this many times, but we need to see that 50 in gold for a starting point, which is really my downtrend line. They need to take that out, hold it, before you can really start to get anywhere near excited about being a longer term bull. And then you need to get above the 200 there in purple before you start really celebrating and start spending some of those future profits. But that's what I would how I would look at it right now. But I'm can this bounce go? Sure. Well, could they close the gap on Monday? Sure. But this just the action, I don't think is really that great in terms of making a forecast, but the trading action during the day is actually pretty good. So we covered all those. This is another thing that's going to confirm that it's not easy right now. The dollar, right? We were looking at the dollar, the market, we've been saying, right? Dollar goes up, the market has gone down in many cases. Dollar goes down, the market goes up. And you can see the dollar's languishing, and it doesn't really look good with many SMAs downsloping. But the dollar hasn't really done much for a while, and the market hasn't done much for a while. Yields, they haven't been, I guess, I don't need the dollar sign. Yields, 10-year yield, this hasn't been maybe as bad as the dollar in terms of what it's not done, but this hasn't really done all that much either. I mean, we are this close, let's pick a close versus another level. So the low on this day here. So yeah, about 6 weeks ago, we were at this level, and we've been pretty much equally distant above it and below it somewhat. So what do you say there? It does look like yields are overall, this yield does look like it's down sloping, and some of the SMAs are down sloping, but it also hasn't broken definitively yet. So we have to wait that out, but that's not telling us anything special at the moment. I don't think, where I could say, well, hey, look, yields are cratering. Market probably is going to love that. It's going to go. I don't see it. The VIX, we talk about this most weeks. The VIX was on its way. And then again, the expression a lot of people have been using for a long time is they monkey hammered it on Friday right back down. I mean, the thing traded right here. You are Thursday, you're trading, finally making your way back into the low 20s. And then by the low, there in this, it has a 16 handle at the low on Friday. So that is what it is right now. That's a tough space. It's been hard to say much about it, but I don't know what a 17 VIX really shouts to us right now. It shouts to me like you got to wait for this thing to start doing something again before you get much out of it. I mean, you need to see either the lows get taken out because we break out, or this thing starts reversing back up because maybe more banking sector issues develop. So we got that. Now let's take a look at SMH. This is an important sector. SMH could be, because it has corrected, because it's off the highs and it's at a juncture where, to me, right, higher low gets put in, bounced basically just above the 100, shoots up, gets hit at the 20, hits the 20 in light blue, comes back down, puts in a higher low, and then reverses. So I think, right, just basic charting, I think you're on the verge of an attempt to break out and right the ship. So we could probably put something right about there. There may be a line. Other folks would probably draw a line in somewhere around here. That one's probably got some validity to it. But if you can break out above this high, what's that, 125.18 after the split, and then this high is 124.97. So yeah, this looks like there's a little bit of a flat line there to me, some in that 125 range. But yeah, this is trying to do something, so I'd give it a chance, right? I'd say, look at this snapshot in time. You really can't, I don't think, hate those technicals, that they're at least trying to put a second leg together, maybe starting a second leg to move up, and that would help the market a lot. And I think this is, if you look at NVIDIA's chart, it's somewhat similar. So in the sense that it looks a little bit more positive, I think, than negative, right? Because it did have that big drop, just like SMH, and just because it is a large component. And look, at reverse strongly, SMH reverses strongly, but this looks a little better in the sense that, right, all these SMAs are rising, and even the shorties are rising, and it does have earnings out here. So maybe it goes on this kind of pre-earnings run as it has before, right? You can see the lead up into earnings is not a bad little, it's something I always like try to keep track of when I put the UOA ideas, and I love to see UOA hit. And if we're in a bullish market, I love to see really aggressive call buying hit about 3 weeks in front of the earnings, because that's telling me that there's a possibility that one of those pre-EPS runs could start to develop. And of course, the charts look good in the stock, I'd be all too willing to go with something like that. Rather than speculate on the earnings, which anything can happen by then. I'd rather catch the pre-EPS run. And if you decide to connect some dots and stay in for earnings, use some of the so-called house's money, I feel a lot better after I've already done well on that pre-earnings scamper. But that looks pretty poised right there. Like if they want to rally this and break it out, it could be challenging some of these highest high levels that it put in before the major swoon that it suffered in 22. And this, of course, has some of the AI component. But I think that was worth a look. I want to come back to things. We already took at the take a look at the four majors, but what I'd like to do is take a look here. And we'll cover this again, probably briefly in sector situation, but technology looks good. Right? If we look at the 12 sectors on this grid, the tech sector looks good. Some of the other ones, they pretty much mimic the market, but a couple of them are again trying to work their way back up. But really, I don't see anything altogether that amazing that I would say, well, yeah, I mean, you could break out, but you're not close to taking out highs in materials. You're not close to taking out recent highs in industrials. You're not close in where was I? Yeah, financials, of course, had a little bit of a recovery on whatever rumor they floated to create the recovery in this there on Friday. But they're not close to breaking out just yet. They need to do some work, probably 3% before that could really be on its way somewhere. Real estate, not too bad, but this is the one that I think sticks out, and maybe a bounce trade in energy, although energy's kind of concerning, I think, overall, which we'll talk about. But XLK, that's the one that is there, right? So kind of confirms the SMH, the NVIDIA, and some of the big caps. But overall, it's not like we can look at this and say, my gosh, 9 of those sectors look like they're ready to really bust out and go bonkers, right? It just doesn't look that way. So there's nothing there that's great tell for us. We did highlight the ones that are important. We did look at the 4 major index ETFs. So I think what I'm going to do is just bring these up off screen. And where's my little, is it this one? Yeah, it's this one here. So I'm going to bring up the list and we'll go through these mega caps and then we'll kind of wrap things up. But I'll just reiterate with Apple. Let's take a look at Apple, a little bit longer term view. And, that's gone haywire, of course, on the news. I have a let's see, come on, Bluetooth. I have an oval here. Might just, I think that's just to highlight where that is. So maybe you're going to challenge that. That's probably why I did put it there. We're going to challenge that. And, but right now, right, you can see that it's getting up there towards the upper Bollinger Band, and it's gotten very stretched from its 200-day in purple right there. Now, it has been more stretched. If you go back to a period like this, I think you can see that it's even more stretched from the 200-day. But I'm just kind of giving a little bit of a warning on that. Like if you're playing that still because the momentum's still there, I'd be a roller, right? I would be an aggressive roller. Hey, I just made money. Okay, I'm going to overroll to the slightly out of the money. Hey, I made money again. Okay, I'm going to overroll to the slightly out of the money because I don't want to leave too much in there at a stage like this. I mean, the RSI on the weekly is 67. The RSI on the daily is 67. So you're up there. It doesn't mean it can't keep going, of course, but that to me would be concerning if I'm a bull, in that a lot of what I might get out of Apple was probably there already. Now, of course, the next biggest one is Microsoft, founded by famous land baron and smiling globalist Bill Gates. And so this is outside of his Bollinger Bands. This is clicking in, if I round it, 69 on the weekly. It's 69 on the daily in RSI. So could you get more? Sure. Would I trade it if it keeps breaking out? Yeah, I would. Because if the whole market's operating in a squeeze type phase, right, you could get more madness out of that. I don't think I would be overstaying my welcome. I would be on guard for overstaying my welcome, though. I think it's not like this party just started in the stock. It's probably closer to 4 a.m. than it is 11 p.m. So I think the party's probably maybe still raging, but bottom line is the easy money has been made on this particular up move. And you can still get some, but you got to be really, I think, deft in how you handle that. Google has plenty of room to go if it wants it, but it hasn't even really threatened to break out this area we talked about. It hasn't threatened in a couple of weeks to get through there. And that's really what it needs to do to really create more potential for itself. So right now it's kind of stuck in the mud. All the short-term SMAs bunched up, but the 50s crossing the 200. Some people love that. That to me is not an instant buy, but it is a positive development. And you've got the other longer-term SMAs moving up, but that's one that could aid the bull case, right? Since it's the third largest weight. Amazon is sort of another one that could help out a little bit if you think that maybe this market finds a way, as it's somehow continued to do. But you could see Amazon, to me, you could see the potentials there. It reminds me of Meta. We kept our eyes on any Meta UOA we could get because we knew, I shouldn't say we knew, but we strongly believed that at some point they would try to put Meta back together again. And we wanted to catch the gap and the gap fill and get on board for that. So you can see the intermediate trends looking better, still kind of below the 200 there in purple. Earnings, of course, are out of the way, and it's really kind of got middling RSI readings. So there's plenty of juice there. That's another one that could help. So if you wonder, well, wait a minute, Apple, Microsoft are down. What's going on here? The next couple I'd look for to explain how they might be moving the market up would be, and not that I like the charts at this moment, like, hey, they're about to go. but they would be two they might rotate into that are probably much better values in some ways, the way people look at things, are better places rather than super overbought, like in Microsoft and to a slightly lesser extent Apple. But Berkshire, this is another one. This is not at the all-time high. It's your fifth largest weight out there. And you can see this has done well lately, but it's not at this point in time. It's because of the way it backed off and didn't recover. It's not overdone. So it could help out more easily than the first two names that we covered. We already talked about NVIDIA. I'll just go through it because it's poised, right? I think NVIDIA is poised to go in terms of technically. I think that this is really a nice little, right? If you're going to pull back with the market and find support and then bounce strongly, you're really close to a breakout level. And you've only really started going back up, for one day, like so many stocks. And you have the pre-EPS run. So I don't know if this is enough. Maybe times have changed and this stock's EPS are enough to be that kind of missing catalyst in a few weeks that I really can't put my finger on right now. Maybe that's what it is. Hey, look, NVIDIA is doing this, but yeah, maybe it is. I don't know. I'm not in those circles, but if they do sort of use this as their lead dog on the team, yeah, I could see this getting more for sure. I could see that powering up quite a bit. And remember, right now it's leaning towards overbought on the daily and the weekly. It's already overbought. But again, we can get more and more so, especially with AI talk and things like that. That kind of happy talk usually works when you're in a wacky phase, and I tend to categorize what we're in right now as somewhat of a wacky phase where I just don't see rates starting to roll over that quickly after they were just raised to a new recent high by the Fed. But again, I think what would be required would be a major issue that probably sends stocks way lower quickly for the Fed to start reacting so dramatically so soon. That would be my take on it. But again, what do I know? Meta, this has been kind of a world beater since October. You could see go from 88 to 245-ish, right? That's just a remarkable run that it's been on. But this is, even despite pulling back, you're at in the lower 60s on RSI on the daily, but on the weekly, you're right near 69 even after this. So again, you got to be, I think, cognizant of the gap fill potentially. This could be one that if it loses the 20 there in blue, probably would try to come close at least to a gap fill. So look for it to not be much help if it starts to take that scenario. Obviously, on the flip side, it could be back above what I would consider the short-term resistance very easily. So if they want to celebrate, start moving this back up, it would just have to work its way through that resistance line I just drew. And then you're going to have probably a flat line at about let's call it 283 and change. I'm sorry, 238 and change. I don't know where I got 83, 238 and change, but that's only a couple percent. So it could be back there. If it can get back up towards 238, then it might start challenging the recent high. And if it does that, you just never know. I still would be concerned about it given where that weekly RSI reading is. Tesla's another one that I still think that gap at some point is going to get addressed, but it didn't this time around. And it does seem, although it's still sort of mired in this longer term downtrend, it does seem primed to where maybe they want to come back and fill this gap here before any further downside happens. So might be one, because the 20 SMA is right there, might be one to keep an eye on. And if they really try to push it, right, maybe it comes back to the 50 there in gold if they take that route. Now, of course, downside's a different story. Probably, right, losing last week's low of 158.93, which is quite a bit away, would probably be the sign that real danger is emerging. Maybe, right, then you take those lows out there, and then maybe finally you do get the closure there. We'll have to see. It looks like I should probably put another little oval down there as well, because it appears to be a little gap right there that has yet to be filled. This gap here clearly hasn't been filled, so we'll leave it alone after that. But this looks like it's trying to do one of those little cycle maneuvers where it cycles back up for a little bit at this moment. So again, bullish market, Tesla starting to take off above the 20. You want to take a shot on that, it would be above virtually all except for the 50, 150, and 200 the longer terms, but even the 100, it would be above, and all the shorties. So it might get that little push. And remember, the weekly ATR on this is still pretty good. It's where's it at here? How come I'm not getting that? Oh, there it is, 24. Yep, I got lost in the shuffle. So that's a really healthy ATR, for the week. So that could be interesting. Visa, like I think this one, I looked at this earlier, I looked at them, all of them earlier, but this also is trying to cycle back up the way the market is. But I have no problem with this in the sense that I don't feel like it's nearly as overbought as Microsoft or anything like that right now. So sorry for all the projections and all that. But this, I don't know what to make out of this right now. This to me, it's got some positive qualities in terms of the long-term upsloping moving averages. Short terms are sort of downsloping, left the gap like so many stocks did, probably at resistance like many stocks are right now. Might have gotten ahead of itself just on Apple news, but really I don't see anything terribly wrong with it, where if they wanted this to somehow continue to keep this intermediate uptrend intact, that they couldn't come in and keep going with it. If they did that, of course, it's a very large weight. So this is another one that could help, but I don't think it looks as potentially imminent as something like an NVIDIA that could really, it's right near a breakout level that could develop into more. And then UNH, we'll do UNH and Exxon, and we'll probably have to call it a day. But here's UNH, and you can see that was having rough stuff occur to it a few weeks ago. It's tried to hang out near the 50 there in gold. It's below everything, but it could be above all the SMAs very quickly with just a decent day or two. So intermediate trend probably down, but again, you have to say, well, there is a higher low put in. This high is higher than some of these other highs. Didn't take out this high, however, but higher low or cluster low at this point. So if it starts to go again, that would be helpful. I don't have anything really great to share on that because the RSI is like right near 50 on both the weekly and the daily. So, it makes sense sort of, right? If you think about, here's the high of this recent range, here's the low, and you're pretty much somewhere near the middle of that. So it all kind of makes sense. There's nothing incredible happening there. And here's Exxon. It's our last one, but this did get hit. And so if this would obviously help if they decide they're going to put a little bounce together here, little gap appears to have happened there, 20 SMA up there in blue. If they have a good week, right, that's where I would guess that maybe they try to jam this thing back up to. It did get, I believe on this day particularly, it got close to getting in the 30s on RSI, but they kept it from even getting worse. But naturally, right, if you see the purple 200 there, if you get this weak little bounce to the 150, which we got on Friday, and then you roll over again below the 200, yeah, I think you then have to start thinking about this lower level probably getting tried, getting tested. And so that could be an even bigger break of the trend. So far, they've kind of held it together. We have to give them that much credit, but it is closer to oversold than overbought. So they could put a little something there together to help out. But it's kind of like, I don't think until you break above the SMAs, like the 100, let's say, or below the 200, that you have an amazing trade on your hand. You would need to see this thing try to do something technically one way or the other before I think you can get back on board it, unless you're already holding and just you've got a longer term view, you like it, you don't like it, or whatever. But I think that's probably going to have to be a wrap. Probably went long on this one, but really I think those tabs were important to set the stage because of the juncture that we're at, to make sure that everyone got a look at those. And if you don't check out Ryan's market outlook that he puts together, market overview, we save a lot of links throughout the week so we can try to keep everyone apprised as to what we're coming across and what's interesting out there, what may be keeping on the back burner, so to speak. But again, the kind of resolution is bottom line, I think right now is we just have to sit tight, still go for singles and doubles as long as they keep us, let's say between 403 and 418. If you're between there, those 15 points, just keep going with the flow, trying to make a little bit of money. And hopefully we're either going to get a breakout or break down. As much as I'm a longer term bear and I'm concerned, I would really welcome the breakout so we can get better trading rather than another leg of the bear market. But I don't feel as though right now I can forecast or even come up with a lean that's really strong because we remain kind of range bound. So a little bit more on the bull side. I'd say this week slightly maybe a little bit better, but kind of dubious at the same time because of the way it was achieved and that late Friday sort of save stuff that we've seen really a lot. We really have seen that a lot since this October low was put in. So I hope something that I share with you helps you out this week or in the future. And I want to say thanks for tuning in. I'll be reporting sector situation very shortly. So I'll see everybody through updates and so on and so forth. Oh, and finally, if you missed the cocktail hour on Friday, one stock I would for dedicated macro measure watchers. There's another stock that could have maybe a pre-EPS run in its future. If the market breaks out, the market goes only really if I would feel better about it. Not that you can't trade it independently, but I'd rather have the market wind at my back. But you can see this really finished well. This has really held on to most of the gains that it has had over the last 5 weeks, closed near the highest level it has in 5 weeks, and bounced right off the 20. It's outside of this triangle. So I think this is one to keep an eye on. It does have a gap back here that could try to fill potentially. So that's kind of my little, if you endured this whole thing, my little bonus for showing up to cocktail hour and enduring macro measure every week, or at least this week, right? And the narrow Bollinger Bands don't hurt either, right? That means like it's probably been it's a little wound. So don't jump into this at 9:30 and 1 second on Monday morning, but I think it's one you should keep on your radar if the market does start to put some more positive stuff together and finds a way to continue to rally. So I just didn't want to forget about that one. So everyone take care and thanks again.